For years, critics have called Warren Buffett outdated, past his prime, and too cautious for modern markets. Many dismissed him as a relic from a bygone investing era, the dinosaur who built his fortune in the 1950s, 60s, 70s, and 80s, but supposedly lost his edge in today's fast-moving, tech-driven financial world. But the recent 2025 market collapse has flipped that narrative on its head. While many of the world's most famous billionaires have seen tens of billions wiped from their fortunes, Buffett has quietly added more than $11.5 billion in gains this year. His patience, discipline, and refusal to chase hype have positioned him as one of the few investors thriving in this volatile environment. This isn't luck. It's the result of decades of sticking to a set of principles that separate real investing from speculation. By examining Buffett's approach, we can better understand how to survive turbulent markets. Not by copying him exactly, but by learning from the mindset that keeps him prepared when others panic. A tale of two billionaire camps. Recent data from Billionaire Wealth Rankings tells a striking story. Among the world's richest individuals, almost everyone has seen enormous losses this year. Jeff Bezos is down around $43 billion. Larry Ellison has lost about $45 billion. Larry Page is down $35 billion. Steve Ballmer has dropped $20 billion. Jensen Huang of NVIDIA, the face of the AI boom, has fallen nearly $28 billion. Michael Dell has seen about $35 billion erased. The pattern is obvious. The high-flying tech leaders who benefited most from euphoric valuations are now watching their wealth shrink dramatically as reality sets in. But two names stand apart: Warren Buffett and Francoise Bettencourt Myers, the L'Oreal heiress. Both have gained money this year. While Myers' fortune benefits from the stability of consumer products, Buffett's gains stem from something more deliberate: his decision to avoid overpaying when markets were frothy, and his willingness to sit still until true bargains appear. Why Buffett plays defense? Buffett has often been mocked during bull markets. During the 2020 to 2021 tech surge, for example, many commentators claim Cathie Wood's ARK funds were crushing Buffett. Investors obsessed over who was winning in the short term, while Buffett simply stuck to his process. That same discipline is what now sets him apart. Instead of aggressively buying into overpriced markets, Buffett has done the opposite. He's been a net seller of stocks, trimming positions and building cash. Last year alone, he sold about $143 billion worth of equities, while only purchasing $9 billion, resulting in a net sale of $134 billion, the largest in Berkshire Hathaway's history. So why would the world's most famous long-term investor suddenly become such a large seller? Because Buffett believes that, in his own words, often nothing looks compelling. In other words, when prices across the market are inflated beyond reason, it's better to wait than to chase a mountain of cash. That patience is reflected in Berkshire's balance sheet. Buffett now sits on an astonishing $341 billion in cash, more than half of Berkshire's equity portfolio, and more than one-third of the company's market capitalization. What's he doing with it? Parking much of it in short-term U.S. Treasuries, which yield about 4%. That might sound boring compared to high-flying tech bets, but at that scale it amounts to roughly $13 billion a year in low-risk income, just for waiting. This is not fear, it's discipline. It's Buffett acknowledging that overpriced assets aren't worth the risk, and that opportunities always come eventually. He's waiting for the moment when top-quality businesses, what he once called filet mignon, become available at hamburger prices. That doesn't happen often, but when it does, he wants the firepower to strike hard. The principles behind Buffett's patience. Buffett's investing philosophy isn't a mystery. He's repeated the same principles for decades, but in times of market euphoria, many forget them. Let's revisit the core ideas. 1. We're investors, not speculators. True investing means buying assets based on the cash flows they'll generate in the future. Speculation means betting on price movements without regard to fundamentals. When you buy a stock, you're not buying a lottery ticket. You're buying a piece of a business. Your return comes from the profits that business produces over time. 2. Every investment is the present value of future cash flows. This principle is as unshakable as gravity. The more you pay today, the lower your future returns will be, unless the business generates more cash than expected. When investors ignore this and pay any price for hot companies, they're not investing. They're gambling on momentum. 3. Don't invest in what you don't understand. Buffett famously avoided tech stocks for decades because he couldn't confidently project their long-term profits. He wasn't saying tech was bad, he was saying he couldn't predict its future. Over time, some tech companies matured into stable blue chips. That's when Buffett felt comfortable buying Apple, which eventually became one of his largest holdings. But he never chased early hype. 4. In the short run, stocks are a voting machine. In the long run, a weighing machine. In the near term, prices reflect popularity, sentiment, and speculation. Over the long term, they reflect actual business performance. That's why Buffett looks for companies where fundamentals are improving even if prices are falling, because eventually the weighing machine rewards real value. 5. A great story can be a terrible investment if you pay too much. This is one of the most important rules. A company can have an amazing product, strong leadership, and an inspiring narrative. But if investors overpay, returns suffer. When the masses fall in love with a stock, odds are high that the price has outrun reality. Conversely, when the masses hate a stock, it may be beaten down too far. The best opportunities are often hiding in unpopularity. Practical takeaways for everyday investors. Most people don't have billions in cash or access to Buffett's deal-making power. So what can the average investor learn from his approach? Dollar cost averaging works. For long-term savers, regularly investing a fixed amount into a diversified portfolio, regardless of market conditions, is one of the most reliable ways to build wealth. It protects you from trying, and usually failing, to time the market. Yes, sometimes you'll buy at higher prices, but you'll also buy at lower ones. Over time, you'll capture the average return of the market, which historically has been enough to meet long-term financial goals. Ask the 3 big questions before buying an individual stock. If you choose to invest in specific companies, apply a simple 3-step filter. Will this company still be around in 10 to 30 years? If not, skip it. Will it likely generate more revenue, profit, and cash flow in that time than it does today? If the future looks stagnant or declining, walk away. Can I buy it today at a reasonable price that allows for a satisfactory return, even if management stumbles a little? If yes, then it may be worth investing. If you can't confidently answer yes to all 3, move on. Stay grounded. When prices swing. When markets rise, news stories tend to reinforce optimism. When markets fall, stories emphasize fear. Don't let headlines dictate your decisions. If fundamentals are improving while prices fall, that can be a buying opportunity. If fundamentals are weakening while prices rise, caution is warranted. Why Buffett's cash pile matters. The last time Buffett held this much cash, it wasn't random. It was because he saw risks others ignored. Historically, his huge cash positions have often preceded market corrections or recessions. This doesn't mean he predicts exact timing. It means he knows overpriced markets eventually correct themselves. By holding cash, he preserves the ability to act when others are forced to sell in panic. Think back to the 2008 financial crisis. Buffett's cash reserves allowed him to strike lucrative deals when other firms were desperate for liquidity. That kind of opportunity doesn't come often, but when it does, only those with patience and dry powder can seize it. The wisdom of waiting. Charlie Munger, Buffett's longtime partner, often emphasized how hard patience really is. Before his passing at age 99, he admitted the recent market was the hardest environment he'd ever seen. That's saying something, coming from someone who lived through nearly a century of economic cycles. If even Munger thought markets had become unusually difficult, it reinforces why Buffett's caution is not cowardice, it's wisdom. Buffett has seen enough market booms and busts to recognize patterns. He knows euphoria breeds recklessness, and recklessness eventually collapses. By holding back when others rush in, he ensures he's ready to act when sanity returns. Conclusion: the dinosaur still rules. Critics love to write Buffett off as a relic of the past. Yet when markets turn volatile, his principles shine brighter than ever. While tech billionaires lost tens of billions in 2025, Buffett gained more than $11.5 billion. While others scrambled, he sat calmly on $341 billion in cash, earning steady returns and waiting for bargains. While hype-driven investors chase stories, he stuck to fundamentals. Buy only what you understand, demand a margin of safety, and never confuse a speculation for investing. The lesson isn't to copy Buffett trade for trade. Your financial situation isn't his, but you can adopt his mindset. Discipline over emotion, patience over haste, and fundamentals over stories. So the next time you hear someone call him a dinosaur, remember, dinosaurs ruled the earth for over 160 million years. Longevity, not short-term excitement, is the true mark of strength.